Assalamu alaikum. Welcome to lecture 17 of AAA, Completion and Final Review. This is the continuation of lecture 16. In fact, lecture 16 and 17 comes under the same topic, but I have divided it into two separate. Lecture 16 was on subsequent events and going concern. That is also the completion stage we do. And 17 is the remaining stages of completion, like final analytical procedure, reviewing financial statement, and other things that needs to be completed, small things like for small issues, like if you have to get any more evidences through representation from management, that is covered in this lecture. And in this lecture we are going to go through how to approach this question from the point of exam, and also we are going to do questions. So we are starting with final analytical procedure and review. Remember, analytical procedure we did it when we were planning audit. Again, we do analytical procedure at the completion stage. But there are some differences and some similarities that we are going to cover. Evaluation of misstatement. So at this stage, when you are about to complete the auditor's report, you evaluate misstatement. Okay, it's like checking your work again before finalizing. It's like checking the draft work. Third, written representation. Okay, value of written representation, under what circumstances you need written representation and all. It's a source of evidence, right? And approach to exam questions. So starting with analytical procedure. Okay, this is used to form opinion. So before you form opinion and decide on the auditor's report, what would be the wording, whether it will be modified or unmodified opinion, auditor should conduct an overall review. See, without this review stage, an auditor just after performing audit cannot give opinion. Review has to be done. Review is the stage before actually issuing the auditor's report. Okay, here auditor should perform this procedures. Number one, review financial statement. Why? To ensure those things. Number one, compliance with accounting standard, whether the financial statement has been complied with accounting standard or not, or any local legislation. Second, accounting policies. The accounting policies that has been used in the financial statement of the client, was it disclosed sufficiently? Okay, then whether they adequately reflect the information and explanation that has been previously obtained and conclusion reached during the course of the audit. See, during audit, auditors must have got some understanding. They have reached some kind of conclusion, right? Now, after reviewing, they are confirming that whether the information that they have got previously, is it inconsistent with the information in the financial statement. So for this three purpose, they review. Second is they perform analytical procedure. Okay, to make sure the conclusion that they reach during the audit is consistent with the financial statement that is presented. Okay, whether financial statement is consistent with auditor's understanding of the entity or not. Third is review the aggregate of uncorrected misstatement to assess whether a material misstatement arise or not. You add the total of uncorrected misstatement and decide whether it is going to lead to a material misstatement or not. Because if it leads to material misstatement, you have to make an adjustment with the management. Now we are going to go through a demonstrate how analytical procedure could be done at the review stage. So in this example, we are going to evaluate the outcome of analytical procedure. They have done the final analytical procedure. Result has been given to you. You have to evaluate. Okay. You don't have to calculate. You don't have to do ratios and all. Already it's given. This is another way a question on this could be asked, right? They will give you the results and you have to interpret. Okay. So they have given you gross profit margin, quick ratio, payable period, and inventory holding period for 2004 and 5. Okay. 2005 they have given both planning and the final. Okay, So if you just quickly go through it without reading additional notes, just see gross profit margin declined, quick ratio declined, payable increased, inventory increased. Now we'll see whether it is inconsistent with information given or not. Okay, first information is company has increased their sale price but they are maintaining the cost. Increased sale price while maintaining a cost at level that is same as 2004. Go and check gross profit margin. See, if you see gross profit margin, it declined, no? So it is not consistent with the first point. Gross profit margin is not declined with point 1. Why? Because when you increase sale price and cost is same, gross profit margin should have increased, right? But it declined. Okay, so not consistent. NC. We'll keep this notes shortly. Okay, and we'll see the answer later on. Second point, company has become reliant on its overdraft facility. So if it becomes reliant on overdraft, quick ratio should decline, and it declined. Quick ratio declined. This is consistent. Third, due to cash restrictions, company encountered delays in paying supplier. Yes, because payable period increased. So this also is consistent. And the fourth, inventory. There is a lower level of slow moving inventory compared to prior year. Please understand, lower level of slow moving inventory. Now slow moving inventory is less compared to last year. So inventory should have reduced, right? Holding period, but it increased. So this is also not consistent with inventory holding period. That's what they've explained in this answer. Just see, point 2 and 3 are consistent with results of final analytical procedure. But point 1 and point 4, they are not consistent because gross profit margin decreased, whereas it should have improved. And inventory holding period should have decreased, but it increased. That's why in point 1 and 4, you need further work when it is not consistent. When other information is not consistent with your analytical procedure results, further work needs to be done. This is why we do review. Imagine if this review was like you skipped the review stage and started preparing audit report. It would be incorrect, no? There could be a material misstatement, and especially in inventory and gross profit. It could be material. Okay. Now, analytical procedure at the completion stage. Okay. See, final analytical procedure. Okay. The procedures are very similar to what you have done at the planning stage, but there are differences between the two stages. The difference is at completion stage. Okay. Financial statements are almost about to finalized, right? That means there should be no further changes to the figure. But at the planning stage, the figures are draft and still you can change them. Next is audit work is almost complete at the completion stage, right? So auditor at this stage, they should have a full understanding of the client's performance. So when analyzing figures also, auditor should document the reason for the movement in their audit file. Okay. And as a result, this analysis should be confirming what the auditor already knows. This is not possible in the planning stage because auditor does not have so much understanding. But at completion stage, when you're doing analytical procedure, auditor has an understanding why the movement could be, what could be the reasons for the movement, and it is documented also. These are the two differences. Now, remember, if something new is identified, or you came across a relationship between balances that you don't understand, you need to do further work in that area. Just now in the previous example we saw, in the gross profit margin and inventory, we need more work because they were not consistent. Analytical procedure result is not consistent with the information that you have got. Okay. So here, auditor have to calculate the movement from year to year, and they have to check that the justifications for any unusual fluctuations are on file. Third, key ratios. There are some key ratios. for analytical procedure. Make sure that you know them. And the formula, you have to know them, by the way, in AAA exam. In any exam, in fact. Formulas are not there in your formula sheet. Gross profit margin, receivable collection period, payment period, inventory holding period, these are key ratios. So you have to check the movement in this. Whether gross profit margin is inclining or declining, receivable collection period going upwards, downwards, payment and inventory. Okay. And reasons of this movement has to be there in the audit file. Next. Then you review a financial statement as a whole. Okay. To make sure that presentation complies with the financial report framework. Whatever you have presented in a financial statement, it complies with the reporting framework. Now, what is the purpose of this review? Auditor should assess through this review whether, number one, that audit work has been performed in accordance with the professional standard. Number two, significant matters has been raised for further considerations and consultation have taken place. Third, it's like a revision, whether your nature, your timing, your extent of the work needs to be revised or not. Evidence. Okay. Audit evidence gathered by the team is sufficient and appropriate to form a conclusion. You are more confident on your evidence that you have got, whether it is appropriate and sufficient to give an opinion or not. And auditor should ensure that initial assessment made at the start of the audit are still valid at the completion stage. Auditor made some assessment, right, at the start of audit. Make sure that it is still valid throughout the audit. When you are reviewing, these things highlights, it comes to the surface. Okay. Or whether the audit plan needs to be flexed. Flex means whether it needs to be adjusted according to the new circumstances. I mean, obviously, come on. Even though auditors make a plan, it is documented, everything. We all know that there are so many uncertainties in the real world. Nothing happens 100% according to plan. We need to be flexible and we need to adjust that plan accordingly. Okay. As the new circumstances unfolds. Next. Evaluation of misstatement, the second part of this lecture. So we're over with the first one, that is final analytical procedure and review. Now we are moving to evaluation and misstatement. Evaluation of misstatement. Here auditor must accumulate the record of all identified misstatement, whether it's material or not. Make a sum of them and then you see whether it could be material or not. Okay, but if it's very small, very insignificant, no need to accumulate them. Second, consider if the existence of such misstatement when aggregated could be material or not. Third, if it is material, revise audit strategy and plan. Then you need to communicate all misstatement to the management. Okay, and you need to make a request that all misstatements needs to be corrected. Okay, and if management refuses to correct those misstatement, what needs to be done? What needs to be done? Auditor should see whether the reasons for their refusal, okay? They needs to consider their reasons for refusal and needs to take into account whether financial statements are free from material misstatement or not. Now, evaluation of uncorrected misstatement, okay? Here, revisit the assessment of materiality to determine whether it is still appropriate in the circumstances. Second, determine whether the uncorrected misstatement, either individually or in aggregate, could be material to the financial statement as a whole or not. Okay, when you're seeing this, make sure you consider both the size of the misstatement and the nature. Some items are, like in terms of their nature, they are material, like related party. If you check by the amount, they might not be material, but the nature is such that they are taken as, they are considered material. Some are material based on the quantitative threshold, the number that is given. So you have to check both. Okay. And the effect of misstatement that is related to the prior period. Because if something could be material in the prior period, chances are this year also it could be material. That's why you need to check in the prior period whether that effect of misstatement was material or not, like on opening balances, on corresponding figure, on comparatives. Okay. And if an individual misstatement is considered material, it cannot be offset by other misstatement. If an individual misstatement is material, remember, you cannot offset it against other misstatements. Okay. You cannot deduct other misstatement from that material misstatement and say that this is an overall misstatement. No. Then all uncorrected misstatement communicate with those charged with governance, and the effect of the audit opinion is to be explained. And finally, you need to request a written representation from the management that they believe the effect of uncorrected misstatement are immaterial. Now we'll go through an example of evaluation of misstatement. So in this example, you have two misstatement that is uncorrected. Okay, one is about a major customer going into liquidation and the amount that is owed is 200,000. Next one is a provision of 300,000 and it has not been recognized. Now you are given the total asset at 35 million and property before tax as 8 million. See, whenever you are given profit before tax, total assets, sales, the reason they give is to test materiality. There's a reason. You have to see whether something is material or not against this. Okay. So here, if you take major customer, okay, in terms of profit before tax, this is 200,000. Okay. So 200,000 divided by profit before tax. Profit before tax is given as 8 million. Okay. Oh, sorry. I will write 0.2 million divided by 8. Okay. The answer will be somewhere around 2.4 something. So it's 2.5%. This one. And if you take it in terms of total asset, 0.2 divided by what is the total asset? 0.2 million. Okay. 200,000 could be written as 0.2 million. 35 million. It would be 0.57%. Okay. So this one, if you see this, they are not material. See, you have to know this thing, by the way. The quantitative threshold you need to memorize. Okay. What is material and what is not material. I've covered this in my materiality lecture. I think it was way before. I don't remember the lecture number, but please go to my previous lecture and check the lecture where I've discussed materiality. There I've discussed the quantitative threshold for profit before tax, then revenue and total assets. They're not material. So irrecoverable debt, if you take it in terms of profit before tax and total asset, not material. Same thing we are going to do for provision. Provision is 300,000. So 0.3 divided by 8, profit before tax. Percentage is 3.75%. You can see. And 0.3 divided by 35. Total asset. 0.86%. This and this. Again is not material. Okay, individually they are not material, but let's check. Take 200 plus 300, provision and irrecoverable debt, which is 500,000. Now if you take it in terms of profit before tax and total asset, it is 6.25 and 1.4%. Both profit before tax and total assets. See, it needs to be for both. Okay, you might be thinking this is material, then this is not material. That's why it's not material. Both measures needs to be material. Okay, here in terms of profit before tax 6.25 is material. In terms of total asset is also material, 1.4. I think between 1 to 2% is for total asset is material. So it's material. Cumulative effect is material. That's why you need to adjust these two amounts to avoid a modified opinion. Otherwise, your opinion will be modified. Okay, so you have to ask the management to correct the misstatement according to ISA 450. Okay. The next is written representation. Okay, value of written representation from management. Okay, so here management says in the written representation, okay, they write it and they confirm that they have fulfilled their responsibilities in the preparation of financial statement, because it is the management's duty to prepare financial statement, not the auditors. Second, to support other audit evidence relevant to the financial statements or a specific assertion, okay, if it is deemed necessary by the auditor. So the representation from management should be like a supporting evidence. It should support other audit evidence relevant to that financial statement assertion to test completeness or accuracy or valuation or whatever it is. Next, auditor has been provided all the relevant information. Okay, this management should write it and give it to auditor in writing. Fourth, the transaction has been recorded, or all transactions has been recorded and reflected in the financial statement. However, if you see in terms of evidence, okay, as a form of evidence, written representations are low in terms of reliability. Okay, why? Because they are internally produced by the management. They are less reliable compared to other evidence. That's why you cannot place your sole reliance on just written representation from management, even though it could be very easy to collect this kind of evidence compared to others. Okay, written representation you collect after you collect the other evidences externally, and you see whether written representation from management is consistent with your other evidences or not. Okay, then on their own, as I told you previously, alone written representation cannot give any sufficient appropriate evidence. It needs to be taken along with another evidence to see. Okay, auditing reporting, what could be the implication of this on the auditor's report? Auditor can issue a disclaimer of opinion if, number two, first two things, okay, if auditor concludes that there are sufficient doubt about the integrity of management. Because if managers, there's a doubt about the integrity of management, if you doubt managements are not honest, okay, the written representation that you get from management, you cannot rely on them. And management does not provide the written representation in the first place. So if these two things are there, disclaimer of opinion. Why? Because you cannot collect the sufficient appropriate evidence to give an opinion. Limitations of written representation. Limitation is, see, when asked for procedures or evidence in the exam, okay, be careful not to suggest written representation for all the areas of testing. You cannot use it for all the areas of testing. Okay. Often examiner told us in their report that weaker students, okay, they do not appreciate the nature of appropriate evidence. They do not understand the meaning of appropriate evidence. Okay, so this means they are going to get less number, okay, in the exam, because they always suggest written representation for any type of issue. For all the test is a written representation. This is a weak answer. You should not do this. Avoid it at any cost. Sometimes for some scenario, written representation might not even be appropriate also. Still, you are suggesting written representation. Marks will be cut for it. Written representations are only appropriate where better evidences are not available. Please understand this. Okay. It is like a last resort for you. And this is generally areas requiring judgment of management, where management have used their own judgment. Okay, it is subjective, no? You cannot take, you cannot verify through other objective means. For example, accounting estimate. This is something management have used their own judgment. You cannot get it from any kind of document or something. Yes, even document might help you some bit. Like you can see the fair value of the assets or liabilities in the open market, but still you have to get a written representation from the management on this area, because judgment of management is used in this area. Accounting estimate is one example. Fraud, error is another example. Okay. other written representation. Okay, as I told you, accounting policies. Okay, where there is a selection and application of accounting policies, you use written representation. Where the following matters has been measured, presented, and disclosed according to the financial reporting framework, written representation. Like, what are the plans or intentions of the entity that can affect the carrying value of assets or liability, and classification of assets and liability. Okay, liability is both contingent and actual, and title to or control over assets. You need written representation on this area, whether assets control has been given to you. Okay, whether liability is contingent or actual liability has been recorded appropriately or not, and regarding laws and regulation, whether there are any aspects of non-compliance with the rules and regulations, laws that could affect financial statement. Not any law. If it affects financial statement only, we are talking about those laws only. Non-compliance with those laws. Then, in the written representation, you have to write the directors have communicated all deficiencies in the internal control to the auditor. Then specific assertions, it could be about class of assets, class of transactions, account balance, or disclosure, requiring management judgment. Now, these are written representation required by the standard, auditing standard. First one is IAC 240. This talks about auditor's responsibility for fraud. Okay. Here, management have to make sure that they inform, okay, they communicate to the director about all the known and the suspected fraud. Next, ISA 250. This is about laws and regulation. If there is any instance of non-compliance, it has been communicated to the auditor. Third, evaluation of misstatement. Okay, managers are giving in writing that that any uncorrected misstatement will be immaterial. ISA 501, okay, about audit evidence. For specific considerations for selected items like litigation cases, okay. So all known actual or possible litigation claim has been disclosed to the auditor. ISA 540, this is about accounting estimates and disclosure, okay. The significant assumptions are used in making estimate. Related party, all related party are disclosed. Subsequent event disclosed. Going concern disclosed. Now, at the end of this lecture, we are approaching towards the exam questions. Okay, so make sure that you practice enough questions on this area. Why? Because at least one question in your exam is going to be on this area for sure. Okay, now here the scenario will state in your exam, this is how it will look like. Okay, in the scenario that will be given to you, they will state that audit is nearly complete and auditor's report is due to be signed soon. Okay, that means majority of the audit work has been done. Only some last remaining issues needs to be resolved. So those are the issues that you have to talk about. Okay, now we'll see. Requirement may ask you to consider several things. One could be matters to consider to enable you to reach to a conclusion. Next is matters to be discussed with the management. Third, what evidence you expect to file on the audit's file. Okay. Then whether sufficient appropriate evidence has been obtained and documented. Further procedures that should be performed to reach a conclusion. So basically all these procedures that needs to be done to reach a conclusion. It could be anything. Matters to be considered with management, evidence that you expect to be filed. Okay, things like that. Now we'll explain in detail few of the points from here. Okay, first one is matters that needs to be discussed with the management. This involves three things. First is materiality. See, whenever there are matters that needs to be discussed with management, make sure that thing is material, because immaterial things we don't discuss with the management, only material things. So you have to make a material assessment. Okay, that means calculate whether that issue is material or not. Next is accounting treatment. State the correct accounting treatment according to the standard and say why your client is wrong, what they are doing wrong, why they are not complying with the standard. Next, third one is risk of material misstatement. What could be the risk of this material misstatement? Okay, state which balance or disclosure in the financial statement is going to be materially misstated. Statements you have to be very clear. Okay, don't give general answer. Specifically you have to say which balances or disclosure is going to be misstated, materially misstated. So this approach is known as MAR. MAR. M stands for materiality, A stands for accounting treatment, R stands for risk. Okay, whenever matters to be discussed with the management, remember this MAR approach in the exam. This is a short. Okay, short for materiality, accounting treatment and risk. Next, evidence that you expect should be on the file. See, this is basically evidence but without an action. Okay, evidence is nothing but it's just same like an audit procedure, but the difference is without an action. In audit procedure you say an action. Action means you say review that, inquire, observe, analytical procedure, discuss, confirm. These are actions. You're telling them what to do. Here is just the evidence. Okay, example like this: copies of board minutes. This is a evidence. Okay, why are you doing it? You expect this to be documented, right? Copies of board minutes. Why? To identify management discussion about legal provision. Next, copy of bank statement to check the payment made by the client. Third, notes of discussion with the management regarding any estimate that management made. Most of the time, if you have seen, these three are very common things that you need expect to be documented. One is board minutes, bank statement, and management discussion with management, because most of the information you can get from them only. Bank statement for payment, board minutes for any future discussion like whether reconstruction or they are planning whether there's any provision, and discussion with management regarding estimates and all. Okay, then whether sufficient appropriate evidence has been obtained. Here firstly you see whether all the procedures you would expect are performed or not. Second, whether the procedures performed are appropriate or not. Okay, that means too much reliance should not be placed on a written representation or inquiries from the management. Then, whether sufficient testing was performed. See, if you are taking a smaller sample size, chances are evidences are not sufficient. For evidence to be sufficient means quantity, make sure that you choose the appropriate sample size. Okay, in the audit plan. And whether auditor performing the work has demonstrated professional skepticism. Professional skepticism needs to be performed, okay, when collecting evidence. Now, further procedure that should be performed. When we are discussing about further procedure, there's you can see I've used three different colors: red, black, and blue. I will tell you why. So, procedure should describe. So that further procedure should describe an action, should be applied to a source, and it should achieve an objective. That means every procedure, further procedure will have these three things: an action, a source, and an objective. It should have. I will show you how. Let's, for example, first one. You see, first one also I have red, black, and blue. Why? Red stands for action, black is the source, and blue is the objective. Because in a sentence, you should know what is the action, what is the source, and what is the objective. That's why, in order for you to help you to understand it better, what is the action, what is the source, and what is the objective, what I've done, I've used the colors, different color. Action for red, source for black, objective for blue. In each sentence, there are 4 sentences. First, review. A review is an action. Board minutes is a source of evidence. And objective is identify management discussion about legal provision. So review the most recent board minutes to identify management discussion about legal provision. Okay. If you see the word recent, this is what you do at the completion stage. Most recent, you must have already went through board minutes, but this time is the most recent board minutes to see whether there are any changes in the case of the legal provision, whether it improved or it became worse, right? Next, again, review recent correspondence. Can you see the word recent? Yes, that's what you do in the further procedure. Again, review recent correspondence with the lawyer. Okay, to whether there are any changes in the outcome of the case. Third, discuss with the management about the progress that is made in terms of legal claim, whether agreement of an out of court settlement could be done or not. And inspect bank statement, recent bank statement, whether there has been any payment for the settlement of the legal case. So you see all these four are testing one thing only about the legal case, but it is from various sources. One is from the bank statement for the payment, one is with the management for the progress of the legal case, one is with the lawyer, and one is from the company, board minutes. Okay. Now, further procedure, you need to be very careful. Further procedures are those procedures that you did not already carry out before in the planning stage. Okay. This is to provide new information. The purpose of this procedure is what? To provide new information. That's why we say recent board minutes, recent bank statement, recent correspondence. And make sure that you suggest audit procedures that needs to be carried out at this stage of audit and not audit procedure that already has been performed. Okay, because if you say in the beginning stage, planning stage, that review the most recent bank statement does not make sense. It comes at the completion stage. Okay, and in most cases, question will go on to ask for the reporting implication if the issues are not resolved. For example, through further audit procedure, you are not able to come to a conclusion. Okay, what are the reporting implications? That means impact of the auditor's report, the auditor's opinion. So that's it for this lecture. Before we do the two questions on this topic, first we'll summarize what we have discussed in this lecture. We went through analytical procedure, okay, to make sure that financial statements are consistent with the framework. Next, financial statements are consistent with the auditor's understanding. And third, to reach a conclusion. Then review procedure to ensure whether the audit plan needs to be adjusted or not, whether work has been done properly or not. I mean, quality standard. Okay, sufficient evidence has been obtained or not. ISAs are followed or not, the auditing standard. Then we went through evaluation of misstatement to assess materiality. Okay, ask management to correct, consider the impact if not corrected, and written representation. It is the management's responsibility, okay, to prepare financial statement, provide audit evidence, all recorded transactions, support other evidence. Remember, written representation should be used along with other evidence if you want to bring a more meaningful conclusion. Okay, and required by other auditing standard. We have seen that list, right? For fraud, for misstatement, for going concern. So that's it. Now we'll be doing questions. Test your understanding one. So in this question, you have been given three different issues, okay, that needs to be communicated with the manager. You can see A, B, and C. And the requirement says explain the matter which should be discussed with the management in relation to each of the issues, 10 marks. This 10 marks is overall. They didn't split. Okay. So before we read the three issues, see, when AAA question is given in exam, okay, you should know how to start a question, what to read. First, you should know the order because it saves a lot of time. The small things, even though it looks very small, okay, but the small things are the key for you to pass your AAA. Okay, because most of you, what happens the moment you see a question, what do? Okay, you are the responsible manager for this one, and you start reading A, B, and C. Okay, by the time you reach to C, B, you forgot what's there in A. By the time you reach C, you forgot what's there in B. It happens because our mind cannot take so much of information at the same time. We can only give one information at a time. Okay, so since this are three separate matter, okay, they are not related to each other. Three separate matters only will be given to you. Okay, independent matter. You can answer them in any order. That's a good thing. Okay, my approach is the way I solve a question is if they are not dependent on each other. For example, there are some questions where you have like this in part A, first part of A, second part of A, third part of A. Okay, if a question is like this, you need to answer it in order given. Why? Because for the second part you need the answer from the first, and for the third you need the answer from the second. It's brought forward. But if it's A, B, and C, it's not related. Most of the time it's not related. Okay, I can tell this based on experience. Okay, but since you are new to AAA, if you are doing a question for the first time, you will not know this pattern. This is small things, but it matters a lot. I told you that A, B, and C are separate. For you to know A, B, C are separate, you need to do lots of questions in AAA to know that pattern. There is always a pattern. You need to find that pattern in AAA that will help you to pass AAA. Otherwise, AAA will become very difficult. Okay, because every answer in AAA, if you study it in group means topic wise, it's very easy. Because for example, if you are doing questions just on audit procedure, you will find there's a pattern. If you do just questions on materiality or group audit, there's a pattern. That's why when you do questions in AAA, make sure that you do it in group wise. Like for example, if you are doing materiality, just focus on materiality and do all the questions on materiality. It should not be like you are doing 5 6 questions on different topics on one day. Otherwise you will get very confused. For example, one from materiality, one from group audit, one from other issues, one from uh, planning stage, one from completion stage. It should not be like that. That's okay. So now first read the requirement. Okay, whenever you get a question, the first thing is your eye should be here on the requirement and look at the number of marks. First thing is requirement. After you read the requirement, second is read the background. This is the second stage. And then comes third, fourth, fifth. Then you go to specific issues and start reading it. This should be the order that you do triple, not just triple A, any question in fact in ACCA P level. This the same thing is done in SBL also. Specifically SBL because SBL is lot to read. Then SBR, AFM, ATX is the same. Okay, because usually background will not be more than 2 3 lines. Okay, in background what do they say? They usually give you in audit, what do they give you? They give you profit before tax. They give you total assets and sales sometimes. Okay, in order to test materiality. And then they say which company they are in and what and who you are, what is your role. That's it. Not more than 4 to 5 lines. This should not take so much of time. Okay, so you are a manager responsible for the audit of a company which provide cargo services with a small fleet of aircraft. Okay, so they have given you the financial statement results both for 2005 as well as for 2004 inside the bracket for you to compare. So profit before tax, you see 2005 it's 2.7, 2004 it was 2.2. It increased. Total asset was 10.4 and 9.8 previous year. Okay, what I do, I read one issue, write answer for it, read another one, write answer. So basically I time each issue separately. For example, it's 10 marks. You need to decide. Okay, obviously you cannot divide equally. 5 5 5. Okay, it's 10 marks. So Let's say maybe this is 3, this is 3, this is 3. Okay. Equally first divide, because there are 3 and number is 10. It's difficult to for an even number to divide by an odd number of requirements. I understand. But in one of them, okay, this you will not understand yet, because once you read, then only you will understand which one has more to write. In at least one of them, okay, out of this 3, one of them might have 4 marks, 1 mark more. Okay, you can give, like, this is just my way of doing it. Okay, and it has worked for me. Trust me, it always works for any paper. I have followed all the papers that I have passed. I have followed this strategy only. Okay, when we are not sure how many points to write, when marks are not divided. Okay, so this is what I follow. Maybe this one 4, or maybe this is 3 and this one is 4, or maybe this one is 3, this one is 4. It could be any combination, does not matter. Okay, so first one, we'll read first and then I will start answering. I immediately answer because they're not related. Okay, because by the time I read A, things are fresh in my mind, so I can write also fast. You understanding what I mean? So here it is about selling a cargo carrier at a loss of 400,000. It's a loss. The cost of that aircraft was 1.2 million when it was purchased 9 years ago, and useful life was 20 years. Okay, according to the minutes of board meeting, this sale was approved. By whom? By the finance director. But that finance director also has a 30% equity interest in Abra. Abra is the company whom they have sold this cargo carrier. Okay, something is clicking in your mind, that he's a finance director having an interest in the company where he have sold that cargo carrier. Okay, that also 30% equity. Think. Obviously, now we'll be answering it. I mean, out of this, what matter needs to be communicated to the management? That is the requirement, right? Think. Before you understand what to communicate, you have to understand the issue. Which standard they are dealing. What is that thing which is wrong, not correct? Issue means something which is not correct. What is it? It's a related party. Exactly. If you have thought about this term, you are on the board, you're on the right track. First thing in AAA is to identify the issue in 1 or 2 words. If you are able to do that properly, rest is all easy. You can use the standard and answer. So related party. So the issue is, it's a related party. And what is it? It's a 30% equity. 30% means it has an influence. Okay, between 20 to 50%, it's an associate. Okay, so if you see, he's a finance director and he's an associate in the company which he has sold, so they are related. Because he's a finance director, why are they related? You have to give reasons. Key management person. He's a key management personnel. I will come to the answer shortly, but this are what we need to answer. Okay, this is like a web I am creating. All the possible things. Okay. Now, it's a cargo. Remember, it's a cargo carrier. What is it? What is cargo carrier? It's a related party. I understand. Transaction is related party after they've sold, but cargo carrier is a non-current asset. NCA, non-current asset. Which standard? IAS 16. You have. This is where your SBI knowledge is very helpful. IAS 16 rule. Okay. So you have to understand what IAS 16 talks about. When you are selling it, how you have to record for it and all. But before doing all this issue, remember, you have been given some numbers here: profit before tax and total asset, and you have sold it at a loss. Why? First thing is, always check materiality, whether something is material or not. After this, you will decide on your action, whether to disclose, whether to inform management, what to do, what not to do. Everything starts with materiality. This is not only for A, it's for A, B, and C all. Remember this steps forever. Okay, so now we'll see the answer. You see, when we are writing, first should be matters to be discussed with management. You have to use this kind of subheadings. You will be typing this because you are writing your exam on a CB platform now. No more it's a paper based exam. Okay, type it. When you're writing it, make it bold so that it is clear that it's a subheading. Next, A, give a name for it. Just don't write A and start answering. So that looking at it, examiner knows what you're talking about. It's a related party transaction. And it's a sale of cargo carrier. Okay. Now, always start with the number, whether something is material or not. So you have made a 400,000 loss. Compare that loss with the profit given. And it was for 2005. So 400 loss, that means 0.4 million divided by what was the profit before tax? 2.7. This one. 2.7 million. So it's 2.7 million. Okay, if you get it in terms of percentage, you will get 14 point something. More than 14.5. So 15%. Take a whole number. Okay, 15%. So this 400 loss represents 15% of profit before tax is material. So because it is material, next what should you write? Disclosure is required. Because it's material, disclosure as a separate line item is appropriate. This is how you start answering. First start with materiality, then if it's material, you disclose. If it's not material, even if you don't disclose, it's fine. But in some cases, even if it's not material, you need to disclose. There are some things, we'll go through them later. Okay, exceptional cases are there because it is required by the law or the nature, but because in terms of nature it is material, you need to disclose. Even if in terms of quantitative threshold like numbers, it's not material, but maybe nature is material or required by law, then you need to disclose. Okay, now always whenever related party transaction is there, remember this, you need to give reasons. It could be one reason, it could be two reasons, it could be three reasons, depending on number of reasons that is there from the case study you can make. You have to give reason why it's related party. Okay, so this first paragraph is about materiality. You don't have to write this, I'm just making you understand how we came to this materiality. Next is why it is related party, give reasons. Always, this is always, not only in this question, whenever related party transaction ever occurs, give reasons why it is a related party. Then only you can give correct treatments, accounting treatment. Because number one is a key management personnel, finance director, right? The one where they are selling, they're the finance director of that. It's like you are selling to someone, selling to your customer, and in your customer, okay, in the customer's entity, you have 30% stake. Okay. So who is related to whom? The seller and the purchase company. Aprar has purchased from the Aspersian company. They both are related because Lien, the finance director, he's a key management personnel. Okay, number one reason. Number two, why they are related is equity interest. Look at the percentage. It is greater than 20%, means it's an associate. Equity interest, but it's an associate. Associate means they have significant influence. Either a significant influence or just say they are associate. Whatever, it's the same thing. Second reason is this. So let's say this is for 4 marks. Okay, 1 mark you will get here, another mark you will get here. Let's say, and let's see where the other 2 marks comes from. Okay, it's quite big. So now I think things are becoming more clear and more easy for you to answer, right? Even though if you see the length, it looks very long. If you start reading the answer, okay, in the first instance, you might start panicking, thinking why it's long and how do I know what to write and how do I think about such long answers. No, don't look at the quantity. Look at what is there in the content and how did they arrive to that content. To know that you have to be very good in your content. First of all, the knowledge that you will get from my lecture. Second thing is the tips and tricks that I tell you. Start by requirement, then read the background, then read this one, then the layout basically. Start with materiality, then why. Now is the disclosure part. This is the disclosure part. What you need to disclose. So another part is for this. Even though it looks too many, but you will only get 1 mark. Even though it looks like a lot of things you are writing, it's not 1 mark for this, another mark for this. I mean, it will add up to so many marks, no? The question itself is only for, let's say, 3-4 marks. Okay? Another mark is for the disclosure. That means the right treatment. Okay? Now you know sale of cargo is a related party. Okay? So you have to disclose this as a note to financial statement. So these are the 3 things, 1, 2, 3, that your note have to disclose. What is it? Amount. In this case, what is the sale proceed and what is the loss? You have to disclose. Any outstanding balance from Abrar, your customer, disclose. Nature of the relationship, disclose. Nature is means he's the finance director of this one and he's an key management personnel, that's why they're related. Okay, that is the nature of the relationship. And he's an associate, so they are related. That's the nature. Now, so which standard? IS 24. Okay. Remember, for related party, I told you before, transaction has to be disclosed, even if the transaction took place on an arm's length basis. Related party means it's not at arm's length basis, no? Most of the time, it's not at arm's length basis. Arm's length basis means whatever transaction that takes place in the terms of open market, whatever the term that is there in the open market, the prices that they are charging in the open market, fair value of assets and liabilities. Okay, what is there for the third party, the prices that is available for the third party in the open market. That is the meaning of arm's length basis. But what happens in a related party, you might charge prices very high or very low. Okay, that is not at a fair value, that is not at an arm's length basis. Okay, most of the time related parties are like that. But even let's say assume they are at arm's length basis, still you need to disclose. Why? Why? Because I told you, nature of the transaction is such that they are material. Related party by nature, they are material. So you have to disclose them. And even IS 24 says that, according to rule of IS 24. Okay, because if you are not complying, if you are not, let's say you are not disclosing, then there's a material misstatement. You are not complying with IS 24. Okay. So what could be the reason for the loss? Okay. Now, so all this disclosures and all, 1 mark. This itself, the whole thing is 1 mark. Okay. And this, the last paragraph is like a conclusion. This another 1 mark. So this adds up to 4 marks. Okay. Here, what you're disclosing, reason for the loss on sale. Usually we sell at a profit, but it's a thing to worry. Why is it at loss? Right? This should be considered. There could be 3 reasons. What is it? Maybe the sale was below the market value. That means it's not at arm's length. Maybe that aircraft, okay, had a bad maintenance history, or let's say it's impaired, because if it's impaired also, it could be. Or useful life is less than 20 years. Useful life of the cargo carrier is less than 20 years. Maybe that's why you have sold it at a loss. Anyway, if the latter means you are not selling, okay, you are keeping the non-current asset. So non-current assets, if you are still using it, okay, I mean relating to the cargo carriers, then it could be materially overstated. Non-current assets in this case could be materially overstated. Okay, basically in the last step, what you have to do is, in any issue, whether something is overstated, okay, in terms of profit, asset, or revenue, or cash, this 4, whether it is overstated or understated, this is what you have to write. Sorry, my handwriting is not clear. I will write it again. Overstated or understated. This is what you have to mention. The last 1 mark is for that only. In this case, non-current asset is overstated. And if it is overstated, remember, both your non-current asset will be overstated as well as the profit. Why profit? Because depreciation is linked to non-current asset and depreciation is an expense. Your depreciation will be lower if your non-current assets is this one, right? The policies that you use for depreciation may not be appropriate. So that's why profits would be higher. Okay. Now, with this understanding, similar way we are going to answer B and C also. But let's read what is B. B is regarding to, again, it is about cargo carrier. But it's a different. What is different? Here they are owning 2 light aircraft which was purchased in June. This 2 aircraft was purchased to give business passenger flight. Okay, they are under 3-year contract. Because it was purchased 2002 and now it's 2005. They have a contract to provide business purchase flight. Now they came to know that they will not renew the contract, okay, and it will expire at the end of September 2005. But they don't know what to do after it. Okay, they don't know what to do with the aircraft after this date. The cost of the aircraft is 900,000, but in the financial statement, the carrying amount is 720,000. What needs to be done? I told you, check materiality. You have been given the cost 900 and carrying amount 720. Check this 720 against your total assets 10.4 million to check whether it's material or not. So 0.72 million divided by 10.4 will lead up to, we'll see the answer now. Second is an impairment. Because you see your carrying amount is less than cost. That's why we wrote impairment as a subheading. Fair enough. If you see it in terms of total asset, the carrying amount, it's 6.9 and it's material. 1 mark. Here, see, earlier it was related party. We don't adjust related party, we disclose. Here, we have to adjust. Okay. Some area we need to adjust and some we have to disclose. It depends. That's why you have to know the standard very well. IS 24 related party says you need to disclose this impairment, you need to change. Okay. According to which standard? IS 36. Always keep your standards in your hand. You should know. Okay. So this could be impairment. Okay. Now, so for that impairment and all, okay, saying that so basically you have to say that the value of aircraft may be impaired, they have to do impairment review and all, you will get another mark. Okay, by saying IS 36 impairment review needs to be done. And you have to evaluate why the recoverable amount has fallen below the carrying amount. Okay. See, this recoverable amount will be affected by the management's intention. That means if the management intend whether they intend to sell the aircraft or they want to use but for alternative purpose, like providing for other business or for the pleasure flights, right? So another 1 mark, I told you. The last one is for what? Overstatement. Here also, non-current asset and profit could be overstated. Risk is there. Why profit? Impairment. Earlier it was depreciation, here it's impairment. If impairment is not charged where it should have been, profit is overstated. And so is non-current asset. Because non-current asset also reduces if you have put the impairment. Because impairment is reduced from the carrying amount of the non-current assets. Right? Additional point. See, you might get an additional, some of you might write this as IFRS 5. That means some of you might think that this passenger business, you cease to use it, right? So this could be a business segment itself. This could be a separate business segment. And if this is to use this, it could be a non-current assets held for sale, IFRS 5. Okay, so session, if you plan to stop this segment, it could be a contract. I mean, it could be a discontinued operation according to IFRS 5. Sorry, it's not non-current assets held for sale because business passenger business is not a non-current asset. Okay, it could be a discontinued operation according to IFRS 5. Some of you might think about this also. If you wrote this instead of the impairment part, you might get you will get the point for this. Okay, but if you don't write it also, you will get full marks for writing impairment and all those things. Coming to C, C is about deferred tax. Okay, there's a change in the tax rate. We'll see. Okay, deferred tax of 570 is there based on some non-current assets, and tax rate was 30%. So they have calculated 30%. See, it's not 30% of sub 570. They have calculated 30%. Okay, on something, on some amount which amounted to 570,000. Understand this. They have got that deferred tax based on 30% on the amount. Okay, but on 1st of June 2005, look at the date, year end is 31st March. Okay, but on 1st of June 2005, government has announced that they are going to increase the tax rate to 34%, from 30 to 34. Now director is also saying to adjust the draft financial statement because of increasing tax rate. But is it correct to adjust or not? We'll see. So again, it's the same thing. Check materiality. Okay, so if you say that 570, okay, 0.57, 570 tax, you have to take it in terms of what? Profit before tax. What is the profit before tax? I kind of forgot also the figure. It's fine, you can always keep revisiting. It is 2.7. I've highlighted it also. This is where highlighting works actually. Okay, so 2.7, it leads to 21%, and it's material. Now do you see the pattern? If you see A, B and C, everywhere they always write by calculating and then saying whether it's material or not. And in all the three situations, it's material. Most of the time they will give you material scenarios only, because then only things comes, no? I mean, then only you can write about it. I mean, what's the point if they give everything in material? Okay. So here, but see, this is deferred tax provision, okay, which is material. But the deferred tax expense or income could be immaterial. Okay, but even if you don't write there this in your answer, is still fine. Okay, now they are calculating what if it increased to 34%. You have to calculate the deferred tax provision first. There are two ways of calculating it. One way they have showed in this one. It's little bit complicated. Okay, some of you might not understand, and you need to memorize this way of finding. Another way I will show you. Okay, how to do that. I mean, there you have to use a little bit of maths, algebra. First, we'll see what it's there in the answer, what's given. Okay, this is the way you calculate whenever something is increased or decreased. Okay, when something is increased, first you start with the percentage that it has increased up to. Latest percentage is 34. Okay, divide by old percentage, that is 30% tax rate. Okay, minus 1. It is 34 divided by 30 minus 1, not 34 divided by 29. Okay, it's not minus, it's first division then minus. Understand this. Then multiply this with tax liability that is given at 30%. Already they have got at 30%, right? 570,000. That at that amount. You have to memorize this formula, by the way, because in future you might be given this, but amount might be different, percentage might be different, but the way of calculating is same. Once you calculate this, you are getting 76,000. This is basically you're finding the increment. Okay, not the increased amount, the increment amount only. That means from 570, you need to increase it up to by 76,000 more. The change is 76,000. Okay, and if you take this 76,000 for profit before tax, which is 0.76, divide by what is the profit? It's 1.4, I think. I guess. Wait, highlighted it. 2.7, 2.7. Calculated in terms of percentage. It is 2.87. Sorry, this is not 0.76. This is 0.076. Okay. It will be 2.8%. It will be 2.8%. 2.8% of profit before tax. Even this is material. Sorry. Individually, this amount is not material. See, individually, if you take, it's not material. Okay. Now, individual is not material. This is one way. I will show you another way of calculating it. So, since, see, this 570,000, they have got after calculating 30% on another amount, some amount. That some amount you need to know, because on that only you will apply 34% to find the deferred tax provision, right? You have to use algebra. Let's put y. Let's use y for that amount on which you have applied 30% and got 570. 570,000 is the result after applying 30% on some amount. So that some amount, okay, that amount will take amount as equal to y. I will put algebra. This is like algebra. Okay, maths only. Y equals to amount. Okay, so we'll put y to know that amount. To find that amount, we are basically finding amount. So we are using y. So 30y, because 30 into the 30 percentage into that amount only you got 570. We are working backwards now. First we need to find y to apply 34%, that increased amount. So it will be 570,000 divided by 30%. 30% means 0.3. Y will be 1,900. I mean 1.9 million. On this, if you apply 30%, you can always check. It's always good to check. Apply 30% on 1.9 million and see whether you are getting 570,000 or not. You should be getting this. Then only this is correct. Verify whether this is correct or not. Now this is correct. This is a little bit long, but this is easier for you to understand. I know this compared to the method that is given. But it's okay. Anyway, any method you can use. Whatever you feel is easy for you. Percentage increased to 34%. So now apply 34,000 on this. You should be getting the increased amount. That is 646,000. Okay. This 646,000 minus it from 570,000, because before tax provision was 570 at 30. At 34% it is 646. Incremental is 76,000. This is what you have found out. It will be safe. I feel for me the second method is easier, but first method is more quick. Okay, shortcut. Anyway, so now two standards applies here. One is IS 12, the other one is IS 10. Okay, see, this is not material. If it's not material, you do not need adjusting. You only need to disclose according to IS 10. Okay, do not need to adjust. And the increase in tax rate, okay, the main thing why it's non-adjusting. Whenever it's about IS 12, you need to see whether it's adjusting or non-adjusting event. In this case, it's non-adjusting. See, the announcement to increase the tax rate took place on 1st of June. 1st of June is after the reporting period. Reporting period ends at 31st March, right? So it's a non-adjusting event according to IAS 10. Okay, that's why you only need to disclose, you don't have to adjust. So directors are wrong to tell you to adjust the tax liability figure. Okay, if the impact of the change in the tax rate is considered material, it should be disclosed. If the impact is not material, you don't have to disclose. Okay, so if directors adjust the draft financial statement, okay, they will be wrong. They are not complying with two standard here. One is IS 10, one is IS 12. Why IS 10? Because you should not adjust. It's a non-adjusting. Why IS 12? Because according to tax. Okay. So if in this case, both tax expense and associate liability will be misstated. If you go by the directive, both will be what? Misstated. We don't know understatement, overstatement, okay? Because we don't know whether they have recorded or they have not recorded it. That's why misstated. Wherever you're not sure whether understated or overstated, just use misstated. Safe side. Okay. So management, you should inform the management not to make any adjustments to the change in tax rate. Okay. Rather disclose. So you should tell management to disclose. Now we'll be moving on to the next question, that is test your understanding 2. And it's similar to test your understanding 1. Test your understanding 2. So in this question is the same pattern that we have done in test your understanding 1. 3 issues. This time they have given the marks next to each issue. A 8 marks, B 7 marks, C 5 marks. Requirement is the same with additional thing. Okay, here also matters to be considered. Additional is audit evidence that you expect to be in the audit's working papers when you are reviewing. Okay, I will show you how to write all the possible audit evidence, how to think about those audit evidence, because the issue comes as we can't think. I mean, even if something is very straightforward, maybe you can come up with 1 or 2 audit evidences. How to come around 5 to 6 audit evidences. Okay, so that I'm going to show you. And the total mark is 20 marks. Earlier one was 10 marks. Okay, why double? Because here you have to write about audit evidence also. That's the additional thing. Rest everything is same. Here also you have been given the revenue of 31st March 2005 and 2004 also. 42.2 and 41.8, slightly increased. Profit before tax went down to 1.8 from 2.2, and total asset 30.7 from 23.4. Okay, this business is a group. Okay, this is a group business, group audit. Okay, Albredra and subsidiaries, and they are into national restaurants. This business is into national restaurants. Okay, they provide vending and other catering services to corporate clients. They have takein, takeaway and home delivery service. Okay, so in A, what they are doing is they are planning to seize the home delivery service. They have made an announcement. Okay, so the sale is 0.6 million, and in 2004 it was 0.8. Okay, provision was there of 0.2 that has been made. Why this provision? As a compensation for the reduction for the redundant employees. Redundant employees will be the drivers who drive those delivery vehicles. Okay, and this delivery vehicle, because we are going to seize the home delivery service, they have been classified as non-current assets held for sale, and it has been measured at fair value less cost to sell 0.8 million, but the carrying amount was 0.5 million, which is even less than fair value less cost to sell. Sounds something is wrong here also. Why? Because if something is classified as non-current assets held for sale according to IFRS 5, you have to measure it at lower of fair value less cost to sell and the carrying amount. The lower is the carrying amount, but you have wrote 3.3, you have measured it upwards, fair value less cost to sell, which is in excess by 0.3, which is not correct. Here, lot of things needs to be solved. First, you need to see whether it has been correctly classified or not. I mean, the classification that non-current assets held for sale is correct or not. That also you have to first test. If it's correct, then this valuation, whether this is correct or not. Okay? And it's the same pattern. So first we'll see whether it's material or not. Okay? The provision as well as the sales for 8 marks. 8 marks, okay? They didn't tell you how much is for evidence, how much is for matters to be considered. So we'll divide this equally. 4 for evidence, 4 for matters to be considered. Okay? Same for B and C, but B and C will be a little difficult because it's odd marks. But we'll keep, let's say, 4 for this and 3 for evidence, and let's say 2 for this and 3 for evidence. Okay? Roughly you can put any number, it does not matter. Now, so first one is cessation of home delivery service. Subheading is this. Divide this into 2. One matter, one evidence. Matter, evidence, matter, evidence for all the parts. So this is matters that needs to be discussed. And you see here audit evidence. This process is repeated in part B and C also. Okay, I told you there's always pattern. So if you see by the sales value, which is 0.6, okay, and you take this sales value in terms of revenue for 2005, it is 1.4% of the revenue. And check in the previous year also. Previous year it was 1.9%. So it's material both the years. Make sure that you get these percentages. You have to calculate and get 1.9 and 1.4. I'm not going to do it because I've shown you previously in test understanding 1 how to do. Test understanding 2 you'll be able to do. You should be able to do it. Next, materiality is done. Next, what comes? You need to understand whether, because you are seizing. When you are seizing something, you have to decide whether it is a discontinued operation or not. In this case, it does not classify as a discontinued operation. Why? And it's not even a component also of the company. And therefore, the cessation does not classify as a discontinued operation in accordance with IFRS 5. See, IFRS 5 deals with two things. Understand this. One is non-current assets for sale and discontinued operation. Two things. It's not one. Okay. Why it cannot be classified as discontinued operation? You have to give reasons. Okay. The reason is it's a non-cash generating unit. That means independently you cannot generate revenue from having home delivery service. It's a part of a restaurant. Okay. It is not independent of other revenues that you generate from restaurant's kitchen. If it was independent you can generate cash flow, then okay, it makes sense. So according to first one, it's not a component. Next, if you see 1.4% revenue, this is not a major line of business. For it to be a major line of business, it has to be more than 10%. Okay, it's 1.4%. Third, it does not even cover a separate geographical area, the home delivery. It only covers areas around the restaurant. Okay, so 1 mark for this, 1 mark for this to say it's not a discontinued operation, 1 mark for materiality. The other one is for provision. Okay, we'll see the 0.2 million provision, whether that is material or not. If you take it in terms of profit, 11.1%. Okay, it is material. And 10% before allowing for the provision. See, before allowing for the provision means you add the provision back to the profit before tax. Profit before tax was how much? 1.8. 1.8 here. 1.8. Provision was 0.2, right? So add that 0.2 back. Because they told before adjusting for provision, it's 2 million. So provision is 0.2. So 0.2 divided by 2 is 10%. Exactly 10%. Okay. So even you before adjusting for provision also it is material. 10% is material. Okay. If you take this in terms of total assets, the provision, it is 0.6% only. So it's immaterial to the statement of financial position. Okay. So this is about redundancy provision. Okay. You have to use the rule of IS 37 provision. What does it says about redundancy? Whenever redundancy is made, you have to make sure when is the announcement made. You have to talk about this in the answer. So this announcement was made before the year end. Before the year end. Before the year end means there is a present obligation. Okay. So it says provision, yes, it's appropriate. Provision has to be recognized. Okay. So 1 mark for materiality, 1 mark for saying is discontinued operation or not, another mark for provision, and another mark is for this, the final conclusion. Okay. But delivery vehicle, okay, when you're checking delivery vehicle, they should be classified as held for sale. Why? They should be classified as held for sale if their carrying amount will be recovered through sale rather than using it. And that's what you're doing. You're selling them, no? You're not keeping them. That also within less than 12 months. In 12 months, you're selling. So that's why it has to be classified as held for sale. When we're selling held for sale, two conditions needs to be met according to IFRS 5. You have to talk about those two conditions. One, vehicle has to be for immediate sale in their present condition. Two, sale has to be highly probable. Okay. Now you have to talk about point when this classification is incorrect. Okay. So, sorry, I mean here they measured it incorrectly, no? Even if the classification is appropriate, held for sale, but measurement is incorrect in this case. They have put it at fair value less cost to sell, which is in excess of 0.3. Because they should be classified at lower of carrying amount and fair value less cost to sell. Whichever is lower. Lower is carrying amount, but they have measured it at a higher amount. Okay. So this is a revaluation. You have to reverse now. Okay. And if you just take the 0.3 excess, calculate this also in terms of assets and profit. It is material. If you take it in terms of profit, the 0.3 excess, 16.7. But if you take it in terms of total asset, it's less than 1%. In terms of profit, it's material. Okay. So there's a risk that delivery vehicle are overstated. I told you overstated and understated, you have to write at the end, always. Delivery vehicles held for sale are overstated. Now we are coming to audit evidence. Okay. So how many evidence are there? 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay, it's not. See, in your exam, you should only give 2 or 3. Okay, 2 or 3 audit procedures enough for the given for the number of marks. It's for 8 marks, no? Out of 8, let's say 4 is for this and 4. So at least 4 audit procedure is enough. But they have given you all the possible 9. Okay, so out of this 5, write any 4 if it's for your exam. But since we are now learning This is not an exam. We are just for our learning purpose. We'll see all the possible answers. The more we learn, the better it is. Because the more points you have, okay, you know what to write and what to ignore. But if you don't have so many points to write, sometimes it becomes very difficult. The more you know, the better it is always. It's not the other way around. The less you know, the better it is. Yes, you might decide to write less, but at least you have a choice if you have no more. That's the thing I'm trying to talk about. Okay? Because if you know more points, if more marks is given, you can write more. If less marks is given, you can write less from that list. But if you know less points, let's say 1 or 2 points only, and if you are told to write 5 6 procedure, it becomes very difficult. You will not be able to think more. You can only write those 1 and 2 limited points. Okay, that's the reason when we are learning, learn all the possible things. Don't see in terms of marks. Just because it's 5 marks, I will only learn 5 points only. How do you know exactly you are going to get it for 5 marks in your exam? So learn, take this as a learning opportunity and learn all the possible answers. Okay. Same for the matters to be considered also. There also you can write less. It's fine. But at least follow the layout, materiality, then the issues according to the standard. In this case, non-current assets, held for sale and discontinue operation, and overstatement and understatement. These 4 things in any question. Audit evidence. Okay. See, this is regarding a non-current assets held for sale. Think what are the things you might want to know from this, and you are making redundant your drivers also, provision also. Okay, you might want to know whether you want to seize. Okay, whether you, because see, you have made a decision to seize home deliveries. Okay, seize. Okay, I will write it in on the other side. Before we come to the answer, this is a very quick full this thing, helpful technique to know audit evidence. Because you have decided to seize, you might want to know, you want to test this, you want to know whether, you want to confirm whether actually you are seizing or not, because you have announced to seize. So you can test this. How are you going to get it? Minutes of, or board of minutes. Your board of minutes is a very good place when you make a decision. When a company decides anything, whether to expand or liquidate or seize a production line or open another one, all this decision, whether to for law, legal cases, for provision, all these things, bottom minute is a very good source of evidence. Okay, so that's what is the first evidence. Just read copy of board minute. It's a copy because this is at the final stage, this is not at the planning stage, remember. So copy of board minute documenting, it should be documented management's decision to seize the home deliveries, because they have told no whether they are going to make, they have announced they are going to seize. We don't go by announcement, we have to see whether it has been documented in the board minutes, the decision to seize. That's what we are testing. And you can also check refer to press release, because obviously when we make a major decision to seize something or to expand something or to acquire someone or to uh, often it is announced in the press release. So press release also you can write in your answer, or internal memoranda to staff. Obviously the staff might be made aware of it, right? So this one done. Now you understand how we got the first evidence. This should not be in order, it could be in any order. I'm just telling you how you decide on audit evidence. Next one, see, this is based on your decision to seize one part, one department, let's say one segment, let's say, that is home delivery. So you might want to know the revenue, right, from that, because you simply do not want to seize. And if that's where your major customers are, your major revenue are from that area, you might not want to seize. I mean, it's not a wise decision to seize. So how will you know about revenue? So revenue is the next stage. Revenue by segment. You might want to know about revenue by segment. This decision often comes when you want to sell something. You have to check the revenue. Okay. So here extract from management account. This is where, see, all these are inside information. You will only get from managements only, extract or internal document, right? Management account. Through this only you will get. Anything to do with outside, you will get through your customer, your supplier, the government, something published, press release, all those. Same for decision to seize. Both a minute only will be there. So now you know analysis of revenue. This is where you get extracted from the management accounts, showing the amount attributable to home delivery sales. Through this, you will know home delivery sales. When you have segment, this is a very good thing. You might want to break down the sales rather than knowing the total revenue. Okay, done. If you follow this strategy for any audit evidence, trust me, it becomes very easy. You don't even have to memorize audit evidence. You will know it by looking at the scenario. What audit evidence do I need to collect? What could be the next one? This is all regarding cessation only. We are still in that one. We still didn't go to the provision. We still didn't go to the fair value part. Three things are there. One is cessation evidence we have to collect. One is on provision. And the other one is fair value. When you're measuring. Three areas. We are still in the cessation part. That also two audit evidence we got from here. Next. But for different things. Second one is for revenue. First one is for decision to see whether it has been documented or not. What's the third one? Say when you're making a redundancy provision. You might have to, who is getting affected by them? Redundancy provision drivers. Drivers are your employees. You might want to look at the contracts. Their contracts. Employee contract. So that's what. Contracts of employment. Because you want to know the redundancy term for the driver. Where will you get this? From contracts of employment. To see how adequate your redundancy provision is. You see, you're testing your redundancy provision to know whether it is adequate or not with the contract of employee. Because terms are often written there that if a driver is made redundant or any employee, what would be the terms? Always, whenever you are given a scenario where employees are made redundant, look at the contract of employment. You see, it's a link. So third is done. Next. You might want to know whether your provision is correct or not, accurate or not. Provision is accurate or not. Where are you going to get it? You can give a formula maybe. Maybe you have used your own formula so that you can give in the audit evidence. How? Whether it is reasonable or complete or not, the redundancy provision. How? You take the number of driver, take the number of years they've employed and their payment per year and check the total with their total. So this is, you are recalculating. Okay? Done. 4 audit evidences. Next, don't read the answer. I'm explaining and then we'll come to the answer. Then you will understand it better. Immediately if you start reading answer, you will not understand. From where? I mean, don't try to memorize. I told you, don't sit and start memorizing those list of audit evidence. It's not going to take you anywhere. Okay? Next, it's vehicle, right? Delivery vehicle. So delivery vehicle, you might have to test whether the measurement is correct or not, the valuation is correct or not. You might want to test their condition. So we are going to talk in terms of delivery and also depreciation. 3 things comes from delivery vehicle only. So here, if you want to know the carrying amount, okay, carrying amount that is held for sale, whether it is correct or not, where are you going to look for? Non-current asset register. It's always like that. Whenever non-current asset is held for sale or you want to know the actual value, look at the asset register. Extract of this to confirm the carrying amount. You want to know a schedule of depreciated cost of delivery vehicle extracted from the non-current asset register. See, in your non-current asset register, there are a list of non-current assets. Out of that, you're only going to take extracts of delivery vehicles only. So this is done. Next, you want to know the price also of the delivery vehicle. How? You can look for maybe second-hand market prices to know the fair value, to verify the fair value of the vehicle. Still we are in the vehicle only. First one was to know the carrying amount. Next one is to correct the fair value. Third, again, after date net sell proceed from sale of vehicle. Once you have sold the vehicle, then you will compare the proceed with the fair value, estimated fair value, to confirm the fair value. After date, like once you sold, compare that proceed with the estimated fair value and see whether fair value is accurate or not. And what's the next? Physical inspection. Whenever non-current asset is held for sale, physical inspection is a very good thing. You might want to test its condition. Okay. Next, this is a very common for anything. At the end, it's always draft financial statement only. This will be the last estimate. I mean last evidence. Draft financial statement to assess the appropriateness of disclosure, whether to see whether you have disclosed the assets held for sale on the face of the statement of financial position. You have to disclose it. And reconciliation is shown of the carrying amount or not in the beginning as well as at the end of the period. Two things: reconciliation of carrying amount and disclosure of assets held for sale. That's why you review draft financial statement for these two purposes. And reviewing draft financial statement is common for any issue. By the way, this evidence you will see at the end of everything. Even B and C also you will see. So now you see how we make up those audit evidence. Is like a web you have to create. It's like a web. 1, 2, 3. This is how you create. You test the fair value, you test the existence, you test the accuracy of the valuation, then you see the physical condition, all those things. Next, we are moving on to revaluation of premises. Next one is revaluation of premises. Same matters and evidence. I think it's for 7 marks. We'll read. So historically, all the premises were measured at cost. Okay. Now they want to revalue. Okay. 2 properties has already been revalued to 1.7. Another 15 are revalued to 5.4. Remaining 3 are expected to be revalued later in 2005. They are still not revalued. And revaluation surplus has 7.1 in the other comprehensive income. It is IS 16 only, we know that. IS 16 rule applies on revaluation. Okay, again, check materiality in 3 things: 1.7, 5.4 and 7.1. Test all this with a non-current asset. That's what they have done here in B. One 1.7, 5.4, 7.1. All are material. This is 5.7. If you all 3 are taken in terms of total assets, by the way, separately. 5.5, 17.6, 23.1. All are material. So the revaluation is material. Okay. Now you want to change from cost model to revaluation model according to IS 16. So IS 16 is the standard that needs to be applied. Okay. Who is giving this valuation? Some valuers. So because it is some valuers, see, these are matters to be considered with management. Okay. You are getting points. You need to check the independence. You need to check the qualification. You need to check the expertise of those valuers who are putting valuation to that non-current assets. Because if they are independent, if they are qualified, if they have expertise, you can rely on their valuation. That's why. And according to IS 16, see, they have revalued some. Okay. They are going to revalue some. They have still not revalued 3 properties. But according to IS 16, does not permit selective revaluation. That means some you revalue, some you leave it to cost model. No. You have to revalue the whole class of premises.
If you have decided to revalue, entire class of non-current assets in that needs to be revalued. And IS 10 also comes even after reporting date. So any valuation of property after the year end are adjusting event, remember, according to IS 10. Why adjusting? Because in the year end, before the year end, condition exists that says these properties are there. Okay, valuation could have gone up and down. Those properties were there. That's why it's adjusting event. Okay, but in this case, this revaluation exercise is incomplete because 3 properties they have not revalued yet. Okay, so for this 3 property, what will you suggest? If they are expected to be material, expected to be, we still don't know. And but you cannot measure them reasonably. Okay, you cannot estimate you cannot put an estimate for those to include in the financial statement. Then you have to change this policy until that next year. That means this year keep it in the cost model, keep it as a cost model. Next year only you have to change this policy, not only for 3 assets, the entire class. You to change this policy from cost to revaluation, take it next year, do it next year, not this year, because those 3 properties you cannot measure them reliably. That's why. Okay, and there's a risk. So the last one is, I always say overvaluation or undervaluation. There's a risk that property is overvalued as the revaluations do not comply with IS 16, because you should not revalue, but they are revaluing it. So you're overstating property. Always use the word there's a risk. Don't say it with 100% guarantee this property is overstated. Don't use such words in audit. Okay, that's a key. Always keep it in terms of probability, that it could be this or that. There's a risk, there's a risk, there's a risk of this happening, that happening. Okay, now we are coming to audit evidence. How many audit evidences are here? 1 2 3 4 5 6 7 8. No, there are 6. Okay, under the last one, financial statement disclosure, there are this list. Okay, you can write any 3 or 2 depending on the number of marks. Okay, so now this is about non-current asset, right? So it is similar like previously, as I told you. For non-current asset, you might want to see the whether they exist or not. Okay, which you will get through non-current asset register. Okay, schedule of depreciated cost of owned premises extracted from this. Next, you might want to check the valuation. This you will get from valuation certificate for each property to confirm the valuation amount. Okay, copy of this. Then you might want to assess the materiality of each property. So you calculate the difference between valuation and depreciation costs by property to assess materiality. Then physical inspection of those property to confirm condition, especially with the largest surpluses, including the 2 that has been valued before the year end. Okay, 2 property were valued before the year end. You might want to test them as well. Now, see, whenever you have properties and all, okay, you will always have similar property, okay, in a similar style or similar size in that area. Okay, so this information you will get through magazines or local property guides. So you can take extracts from that to see the range of values for similar property. This will help for you to verify your own property. Okay, next is, as I told you, this you will always get financial statement, draft financial statement. Okay, in this case you might want to check the disclosure according to IS 16. They are, if revaluation takes place, you want to know the date. Next, the independent valuer, because for revaluation you need a valuer, so you need to make sure they are independent valuers involved in that process. Third, because they are estimates, you might want to know the assumption and the estimate fair values. And carrying amount recognized under cost model, all these things will be disclosing under IS 16. You have to see for it. Reconciliation of the carrying at the beginning and the end, same like previous, and revaluation surplus in the statement of changes in equity. Now we are moving on to the third issue. This one is for 5 marks. Okay, during the year they have paid 0.1 into fines and penalties for breaching health and safety regulation. 2004 it was 0.3. Okay, they did not separately disclose this, but they have included in the cost of sales. First, check the 0.1 whether it's material or not. Next, we have to see whether this treatment that they have not disclosed separately but included in the cost of sale, it's correct or not. Okay, so 0.1, if you see in terms of profit before tax, it's 5.6% and is material. Okay, now even the payment may be regarded as material by nature. Okay, why? Because it is related to the non-compliance. Payment related to non-compliance with regulation. Such kind of payment by nature are material. Okay, now separate disclosure is not needed when external shareholder is not there. Okay, now see, they have given you the prior year figure, right? So this accounting treatment inclusion in the cost of sales should be consistent with the prior year. If in the last year also you have included it in cost of sales, it makes sense. And also if you see closely, so you have to always keep a close eye, especially with the figures given. If you see here, last year it was 0.3, this year 0.1. So you have to see to it why it declined. It's good, it declined, but why? The reasons could be various. Like, let's say there's an improvement in health and safety, okay, or the thing which could be a risk is that they must have not recorded the liability properly, incomplete recording of liability, maybe they have understated the liability, that's why they are showing an improvement, fall in expense could be. Okay, so in this case there's a risk of inadequate disclosure regarding to fines and penalties and a risk of understatement of those fines. Either they have not disclosed or they've understated if they have disclosed. Now audit evidence relating to this. Okay, there are 5. See, whenever it is about some payment and all, immediately what should come to your mind is cash book, bank statement and cash book for payment to confirm the payment of that thing. In this case, it's fine. This is very easy. Second thing you might want to see is you might want to compare this with the previous year. Whenever you need to check whether something is consistent or not, you have to review or compare with the previous year. Why? Whether something has been omitted or not. Omission. Then regarding liability, so after date cash book and bank statement for payment made in respect of liability. One is to confirm the payment, that payment is made. The other thing is to make sure that you have paid the liability before 31st March 2005. Okay, now this is just by looking at the cash book for payment is not enough. Just by comparing with previous is not enough. You have to look for other sources. Like this is regarding health and safety, right? You have to take a correspondence with them as well. Correspondence from them. Whether, okay, to get notification of liabilities. You have to see. Same like how we get correspondence from lawyers for tax. For legal laws, right? For legal claims and all, same. In this case, we take correspondence with health and safety to make sure about the liability, whether it's correct or not, whether there's actually a liability or not from their side. Think from all the various angles. It's like from various stakeholders' perspective, you have to see the affected people, from whom you have to take information and what type of information you have to take. Okay. Next, this is about notes, right? Disclosure. So Note in the prior year confirming consistency or otherwise lack of separate disclosure. You have to see to this. Whether in the previous year it was disclosed or not. If it was disclosed previous year, that means if this year also you disclose, it shows that it's consistent. Otherwise, it's a lack of disclosure. And the last one could be written representation. This is about fines and penalty. Whenever fine and penalty, you can get a written representation from management saying that there are no fine and penalties other than those that has been reflected in the financial statement, the current ones. Thank you for watching, and I shall see you in my next lecture. That's going to be on auditor's report. Yes, a very interesting topic. I know most of you like that. So it is going to be on auditor's report, the auditor's opinion, and various elements that is there in the auditor's report. So we are going to cover the entire auditor's report, the content in that, how auditor's reports needs to be written. Okay, good answer, bad answer. We are going to go through that, and that's going to be the last lecture under your section E of your AAA syllabus. Before we move on to section F, that is other assignments, that means other assurance services. The audit part and all, we are almost over. Then we are moving on to assurance services, the next section. So don't forget to subscribe to my channel. If you haven't subscribed, make sure that you watch all my previous lecture if you have missed out on any. There is a whole playlist on AAA lecture, that is AAA lecture. And good news is this AAA lecture, you can use it for another one more year, that is till June 2024 you can use it, because there is not much change in the AAA syllabus. Okay, and don't forget to do questions on your from your revision kit on audit procedures, evidence, then group audit, and this one, going concern, completion stage, right, reviewing. And I shall see you in the next lecture. Till then, take care.